Now, as a company, you may have a pension scheme for your employees. You may be operating a pension scheme for your employees. So we want to know first, what is a pension scheme or what is a pension fund? Some books call it pension fund, others call it pension plan, others call it pension scheme. What is a pension scheme or what is a pension fund or what is a pension plan? Okay, now we normally define a pension scheme as an arrangement whereby the employer promises, where the employer promises to provide benefits to the employees when they retire. I've said a pension scheme is an arrangement whereby the employer promises to provide benefits to their employees when they retire. So at the time of retirement, your employer promises you will get a benefit at the time of retirement. So that's how we define a pension scheme. But then the question now is again, how does a pension scheme operate? How does a pension scheme operate? So let me explain how a pension scheme operates. Don't write, we shall put down the notes later. Now, in a pension scheme, normally contributions are made. To a fund. Contributions are normally made to a fund. Those contributions that are made to a fund, they are normally invested by the funding agent, whoever is the funding agent. Once the funding agents invest the contributions, then it is the funding agent who later pays the benefits to the employees when they retire. So in essence, that's how a pension scheme operates. We are saying regular contributions are made to a pension fund. Those contributions are invested by the funding agent, and it is the funding agent who normally pays the benefits to the employees when they retire. Now, of course, the contributions in some cases may be made by the employer only, or in some cases, you as an employee, you contribute, and also the employer also contributes. So the contributions can be made by both the employer and the employee. That means from your salary, you are deducted some amount to send to your pension fund. This pension fund or the funding agent may be an insurance company, or it may be a trustee. There are some insurance company that manages pension schemes on behalf of companies, or we are saying it may be a trustee like an NSSF. NSSF being a trustee, they manage pension scheme. They manage pension scheme as a trustee. Okay, so we are saying in a pension scheme, contributions are made to a fund. Those contributions are invested by the funding agent who later pays the benefits to the employees when they retire. Then we have said the funding agent may be an insurance company, or it may be a trustee. Now, where the contributions are made to an insurance company, we normally refer to that kind of a scheme as an insured fund plan. We normally refer to it as an insured fund plan, where contributions are made to a where contributions are made to an insurance company, then that kind of a scheme is known as an insured fund plan. But where your contributions are made to a trustee, then that kind of a scheme is normally referred to as a trust fund plan. A trust fund plan. So that is how a pension scheme operates. That contributions are made to a funding agent or to a fund. Those contributions are invested by the funding agent. Then it's the funding agent who pays the benefits to the employees when they retire. So now you know what's a pension scheme. Now you know how it operates. Now we are developing. The other question is, again, how do you as an employer go into this kind of arrangement on behalf of your employees? You are the company who wants to start a pension scheme on behalf of your employees. what ways can you use to follow or to go into a pension scheme? There are two ways or two approaches that you as a company you can use to go into a pension scheme. There are two approaches that you as a company may use to go into a pension scheme. We normally refer to those types as what we call types of pension plans. Types of pension plans. There are two types of pension plans that you as an employer you can choose from. Either you choose one or the other. Okay, one way you can use or you can go into a pension scheme on behalf of your employees is to use what we call the defined contribution plan. We call it a defined contribution plan. You can use this plan to go into a pension scheme, a defined contribution plan. The second way you can use as an employer is to use what we call a defined benefit plan. That is a second approach that one can use when you're going into a pension fund on behalf or into a pension scheme on behalf of your employees. So these are the two approaches that one can use. So let me discuss them first before we put them down. What is a defined contribution plan? What's a defined benefit plan? Before I discuss them, I've just told you in a short while how a pension scheme operates. I've told you in a pension scheme, contributions are made to a fund. Contributions are made to a fund. Then I've told you those contributions are invested by the funding agent, and it's the funding agent who normally pays the benefits to the employees when they retire. Okay, now listen. So if your company decides that they are going into a pension scheme using the first approach we are calling the defined contribution plan. Now, in a defined contribution plan, the contributions, listen, the contributions that you as an employer, you're going to make into a fund, those contributions are defined. The contributions are defined. In other words, the contributions are known in advance. The contributions that you as an employer you're going to be sending to the funding agent, those contributions are known in advance. They are defined. For example, it could be that you are agreeing you will be sending 2,000 shillings every month on behalf of the employees to the pension fund. Listen, but listen to this now. But how much will be the benefits the employees will take home 10 years from now, 20 years from now? Those benefits are not defined. The benefits are not defined. I'm still discussing the first approach that we are saying in a defined contribution plan, the contributions to the plan or to the fund, those contributions are defined. They are known in advance. But how much are the benefits at the time of retirement? The benefits that the employees will take home, they are not known in advance. In other words, they are not defined. So the question is this. Now that the benefits are not defined, what will influence the amount that they will take home at the date of retirement? Don't forget, we have said these contributions are normally invested by the funding agent. Every time we send contributions into the fund, the funding agent will normally invest those contributions. It's obvious the funding agent expects an investment return. Now listen. So if the investments perform well in the fund, then it is obvious the fund will be able to have enough money to pay more benefits. In other words, if the investments perform well, then the funding agent will be able to pay higher benefits to the employees when they retire. Otherwise, if the investments perform poorly, then the benefits that the employees will take home will be less. So the amount of the benefits will depend on the performance of the investments in the fund. Okay, the amount of the benefits in this kind of a plan will depend on how the investments perform. Don't forget, they are being invested, we expect a return. So if the investments perform poorly, we have to pay less benefits as a fund. If the investments perform well, we pay more benefits as a fund. So that's all we can say about the first approach, where you as a company, you can use to go into a pensions fund or a pension scheme on behalf of your employees. You can use the defined contribution plan, where the contributions to the fund, they are defined, they are known in advance, but the amount of the benefits that the employees will take home is not defined. Then I've said the amount of the benefits will depend on the performance of the investments in the fund. If the investments perform well, then the benefits will be more. If the investments perform poorly, then the benefits will be less. Good. That's all about that. Let me discuss the second one, which we are calling a defined benefit plan. Again, we have just said contributions are made into a fund. Contributions are made into a fund. Then the funding agent will be the one to pay the benefit. Now listen, in a defined benefit plan, the second approach now, in a defined benefit plan, the benefits that the employees will take home, those benefits are defined. They are known in advance. How much the employee will take home 10 years from now or 5 years from now when he's retiring, that amount is known in advance. Okay, so that amount is known in advance. For example, we could say, let the employees take home 1 million 5 years from now. So the amount of the benefits that the employees will take home at the date of retirement, the amount is known in advance. Listen, but how much the employer will make as contribution to the fund, the contributions are not defined. They are not known in advance. Now listen, so we want to ask ourselves as a company, how much should we then contribute into this fund in order for the fund to create a benefit or a fund of 1 million shillings 10 years from now? We want to know how much should we contribute into this fund in order for this fund to create a fund of 1 million 10 years from now. Listen, it is at this point that you as a company, you will require the services of the people we call actuaries or actuaros. Some call them actuaros, some call them actuaries. You will need their services. You will tell them, I want to create a fund of 1 million 10 years from now for each of my employees. Please calculate for me how much I should be contributing. In other words, you as a company, you will sit down with the actuaries and come up with the scheme or the assumption of the scheme that you want to develop. One of the assumptions you have to make as per the scheme is, what are we expecting? What are we expecting to be the market rate of return in the fund? What are we expecting the fund will be earning? So we try and project the return on investment. The other one we try and project is, how many employees do we have? How many do we expect will be there at the date of retirement? That means you project workers' turnover rate. You also project what we call what will be the salary increment in the future. In other words, sit and come up with the assumptions of the scheme that you want to develop. Of course, one of the major assumptions you have to decide is, what are we expecting to be the rate of return? Let us assume that we project that the rate of return will be 10%, that the fund will be earning a return of 10%. So we now are saying, if the investments will be earning 10%, let this actuary calculate for us how much you should be contributing, so that if it's earning 10%, it will create a fund of 1 million 10 years from now. They might calculate and see that if you contribute 2,000 every month, earning 10% every year, that will create a fund of 1 million 10 years from now, or whatever period of time. Okay, that is how they will calculate. They might calculate and see that if you contribute 2,000, earning a return of 10% for the next 10 years or 20 years, it will create a fund of 1 million. Okay? But then the other question is this now. What if after 2 years, you have already started the scheme, you as an employer, you have been contributing 2,000. It has been earning 10% as per the projections. But maybe after 2 years, now the market is not giving us a return of 10% as per the projection, but now the market is giving us a rate of 8%. So the question is, if we continue contributing the same 2,000, now earning a return of 8%, listen, as a fund, are we able to meet our future obligation of paying 1 million? Of course not. Because if we continue contributing 2,000, earning 8%, it will automatically mean that our fund will have insufficient fund to meet that future obligation. In other words, your fund will have what we call a deficit. Your fund will have what we call a deficit. Then the question is, because we can't change the benefits will still remain 1 million. But we said the contributions are not known, they are not defined. So in order to correct this kind of a scenario, what will the employer be required to do? Obvious, the employer will be required to bring in additional contributions into the scheme so that we make up for the expected shortfall. And that's why we said in a defined benefit plan, the contributions are not known in advance. In other words, they are not defined. We said they are set at such an amount that is expected to earn enough return to meet that future obligation. Now we are realizing that the fund is appearing to have a deficiency. We are not earning 10% as per the projections. We are now earning 8%. So if it becomes apparent that the fund will have insufficient fund, then to make up for the expected shortfall, then the employer will be told to bring in additional contribution. That's why we are saying the contributions are not defined. They may increase or reduce, whatever the case might be. On the other hand, what if we agreed that we shall be contributing 2,000, we projected that it will be earning 10%, but after 2 years or 3 years, now your fund is no longer earning 10%, but your fund is earning 12%. If your fund is now earning 12% and you continue contributing 2,000, now earning 12%, it is obvious this fund will be larger than expected. It will be larger than expected. In other words, it will have what we call a surplus. It will have what we call a surplus. Because if we continue contributing 2,000, earning now 12%, the fund will be bigger than expected. Okay? Now, remember, we can't change the benefits. So what will happen when your fund has a surplus? Now listen, when your fund has a surplus, then the employer will be told to stop contributing for a short while. He has been contributing 2,000, earning 10%, earning 10%. After 2 years, now it's earning 12%. So what the employer will be told to do is to stop contributing for a short while until we utilize the surplus that has been created. That process of stopping to contribute for a short while, we normally refer to it as being the employer being told, listen, the employer therefore will be told to take what we call a contribution holiday. The employer will be told to take what we call a contribution holiday. So let him stop contributing for a short while until we utilize the surplus. Then after that, he can now continue. So that process of stopping to contribute for a short while is what we call a contribution holiday. A contribution holiday. So that's how a defined benefit plan operates. I hope you have noted the difference. Listen, I told you, in a defined contribution plan, the first one, there were no complications. In a defined contribution plan, defined contribution, I told you the contributions are defined. The contributions are defined. In other words, they are known in advance. How much you as an employer or an employee will be contributing to the fund, your obligation is known in advance. You know it. But how much the employees will take home, whether it's 200,000, 300,000 in the future, the amount is not known in advance. I said the amount of the benefit will depend on the performance of the investments in the fund. I said because every time you send contributions to the fund, those contributions are normally invested. Therefore, if the investments therefore perform well in this fund, then it means the fund will be able to afford to pay higher benefits to the employees when they retire. Otherwise, if the investments perform poorly, then the benefits that the employees will take home at the date of retirement, those benefits will be low. So the benefits can either be more or less. That's why we are saying they are not defined in a defined contribution. The other key point I want you to notice is when you're taught to define this term, because at this level, listen, at this level, it is very common to find you being taught to distinguish between a defined contribution plan and a defined benefit plan. Listen, when you're taught to distinguish or to define them, don't just tell the examiner a defined contribution plan is where contributions are defined. As much as you are true, listen, you have not fully defined what it is. I hope you have noticed that when I was talking about those two approaches, I talked about them, each of them, I talked about it from both ends. What happens to the contributions in that approach, at the same time, what happens to the benefit in that same approach. You have to discuss each of them from both the side of contribution and at the same time the side of the benefit. You have to look at it from both ends. Don't just say a defined benefit plan is where the benefits are defined. That's true, but you have not got everything. You have only looked at one side of the equation. There is also the other side about what happens to contribution. If you are discussing a defined contribution plan, what happens to the benefits? And we have said in a defined contribution plan, the contributions are known in advance. They are defined. But the benefits that the employees will take home 10 years from now, those benefits are not known in advance. They are not defined. That's what we are trying to say. And therefore, the question will be, what will influence the amount of the benefits? What will influence the amount of the benefits? We have said it is the performance of the investments in the fund, because the investments are the contributions, are invested. We have said if the investments perform well, the benefits will be more. If the investments perform poorly, then the benefits will be less. So that's about all about the defined contribution plan. There is nothing complicated about it. The second approach is a bit involving. That's what we are calling the defined benefit plan. I have said in a defined benefit plan, the benefits that the employees will take home, whether 10 years or 20 years from now, those benefits are defined. They are known in advance. They are defined. They are known in advance. Could be 1 million, 2 million, whatever it is that you want your employees to take home 10 years from now. But then I said, at the same time, how much are the contributions to the fund? Those contributions, I said, they are not defined. They are not known in advance. The question therefore was, how much as an employer should I contribute to this fund so that it makes or creates a fund of 1 million 10 years from now? Then I said, it's at this point in time that you as a company, you would require the services of the actuaries. You will sit down with them, come up with the assumptions of the scheme. What are the number of employees currently? What are the projected number of employees in the future? What is the current salary? What are we projecting to be the salary increment in the future? What is the workers' turnover rate? And so on. One other thing we have to try and project is the return in the market. What is the return in the market? And we are assuming, suppose you projected that you will be making a return of 10%. The market normally earns 10%. So the actuaries will sit down and calculate and say, if you contribute maybe 2,000 to the fund, earning a return of 10%, that will create a fund of 1 million 20 years from now or 10 years from now, whatever the year may be. But then I have said, what if after some time, while you are still within the 10 year or within the 20th years, within the period, somewhere now you realize the market is not giving you the projected return. It's now giving you a return of 8%. I said, if you continue therefore contributing 2,000, now earning 8%, this fund will have insufficient fund. In other words, the fund will have a deficit. And to correct for that deficit, the employer will be told to do what? To bring in additional contribution into the fund. That's why we say the contributions are not defined, because the employer may be required to bring in additional contribution into the fund so as to make for the expected shortfall. Then I've told you, what if we now earn 12% instead of the 8% that we projected? We have said that if the return is higher, it means if we continue contributing 2,000, now earning 12%, our fund will have more assets, or it will be larger. Your fund will appear to be larger than expected. In other words, your fund will have a surplus. And when your fund has a surplus, how do you correct for that scenario? We said the employer will be told to take a contribution holiday. In other words, let him stop contributing for a short while until we utilize the surplus. Somebody by the name of Perry Daniel had asked a question. I repeat, I hope by repeating you have now okay. Daniel, are you okay now that I proceed? Daniel, are you okay? Because you had said there was, I always confuse between the two. Are you okay now, Daniel? I'm waiting for Daniel to give us an answer, whether he's now okay. What's the difference between a defined contribution plan and a defined benefit plan? Hey, Daniel, are you okay? We hope so. Oh, yes, thank you. Now you are okay. Good. So you have accepted that you are now very clear with them, and I've told you, listen, I've told you at this level of the financial reporting, it is a very common question, especially the theory, to be asked to distinguish between a defined contribution plan and a defined benefit plan. One should be able to. I've also said, when you're told to define them or to distinguish them, don't talk about them from one side only. Talk about from both of them, each of them from both ends. Good. So maybe before I proceed, let's put down something on what you have already said so far. Let's put down something on what you have already said. So the topic is accounting for pension fund, or what you can call pension schemes. Pension fund or pension schemes. That is the topic. Accounting for pension funds or pension schemes. Accounting for pension fund or a pension scheme. Then you can say this. Say this, a pension scheme is an arrangement. A pension scheme is an arrangement whereby a pension scheme is an arrangement whereby the employer, a pension scheme is an arrangement whereby the employer promises, to provide benefits. A pension scheme is an arrangement whereby the employer promises to provide benefits to the employees when they retire. It's an arrangement whereby the employer promises to provide benefits to the employees when they retire. Okay. Then you have another subheading, how pension schemes operate. How pension schemes operate. As a subheading, how pension schemes operate. As a subheading, how pension schemes operate. Then you say this. Then you say this. The employer and possibly the employee. The employer and possibly the employee make a regular contribution. The employer and possibly the employee make a regular contribution into the fund. Make a regular contribution into the fund. Will you stop? The employer and possibly the employee make a regular contribution into the fund. Then you say this. The contributions are invested. The contributions are invested by the funding agent. The contributions are invested by the funding agent. The contributions are invested by the funding agent, comma, who later pays by the funding agent, who later pays the benefits, to the employees when they retire. The contributions are invested by the funding agent, comma, who later pays the benefits to the employees when they retire. When they retire. Another paragraph. The funding agent may be an insurance company. The funding agent may be an insurance company or a trustee. The funding agent may be an insurance company or a trustee. The funding agent may be an insurance company or a trustee. Another paragraph. Where contributions are made to an insurance company, where contributions are made to an insurance company, comma, such a scheme is known as insured fund plan. Such a scheme is known as insured fund plan. Such a scheme is known as insured fund plan. Comma, and where contributions are made to a trustee, and where contributions are made to a trustee, and where contributions are made to a trustee, such a scheme is known as trust fund plan. Is known as trust fund plan. We have said, and where contributions are made to a trustee, comma, such a scheme is known as a trust fund plan. Okay, so that's all about how a pension scheme operates. Now finish. Then you have another subtopic, types of pension plans. Types of pension plans. Types of pension plans. Types of pension plans. Number 1, defined contribution plan. defined contribution plan. Under that you say this, defined contribution plan. Then under that you say this. In this plan, the contributions that are made to the fund, the contributions that are made to the fund are defined. The contributions that are made to the fund are defined. i.e., they are known in advance. They are known in advance. They are known in advance. Comma, but the benefits that the employees will take home, at the date of retirement, are not defined. They are not defined, i.e., not known in advance. Not known in advance. Not known in advance. Another paragraph. The amount of the benefits at the date of retirement, will depend. The amount of the benefits at the date of retirement will depend on the performance of the investment. The amount of the benefits at the time of retirement will depend on the performance of the investments in the fund. The amount of the benefits at the date of retirement will depend on the performance of the investments in the fund. Then you say this. If the investments perform well, then the fund will be able to afford to pay higher benefits. If the investments perform well, then the fund will be able to afford to pay higher benefits to the employees. The fund will be able to afford to pay higher benefits to the employees when they retire. The fund will be able to afford to pay higher benefits to the employees when they retire. Will you stop? If the investments perform poorly, then the fund will pay less benefits to the employees. The fund will pay less benefits to the employees. Good. That's number one. Number two, defined benefit plan. Number two, defined benefit plan. Then you say this. In this plan, the benefits that the employees will get, at the date of retirement The benefits that the employees will get at the date of retirement are defined. The benefits that the employees will get at the date of retirement are defined, i.e., they are known in advance. They are known in advance. They are known in advance. Comma. But the contributions to the fund, are not defined. But the contributions to the fund are not defined. The contributions to the fund are not defined, i.e., they are not known in advance. They are not known in advance. They are not known in advance. The contributions to the fund are not defined, i.e., they are not known in advance. Another paragraph. The contributions are set. The contributions are set at such an amount. The contributions are set at such an amount that is expected. The contributions are set at such an amount that is expected. The contributions are set at such an amount that is expected to earn. That is expected to earn enough return. You can put it, the contributions are set at such an amount that is expected to earn enough. To earn enough return to meet. That is expected to earn enough return to meet the future obligation. To meet the future obligation of paying the benefits. To meet the future obligation of paying the benefits. The contributions are set at such an amount that is expected to earn enough return to meet the obligation of paying the future, or to meet the future obligation of paying the benefit. The amount of contribution is set as such an amount that is expected to earn enough return in order to meet the obligation of paying the benefits. Another paragraph. If it becomes apparent that the investments in the fund, are insufficient, if it becomes apparent that the investments in the fund are insufficient to pay for the benefits, then the employer will be required. I've said, if it becomes apparent that the investments in the fund are insufficient to pay for the benefits, then the employer will be required to make additional contributions. The employer will be required to make additional contributions into the fund. The employer will be required to make additional contributions into the fund so as to make up for the expected shortfall. The employer will be required to make additional contributions into the fund so as to make up for the expected shortfall. Another paragraph. If the funds with an apostrophe, if the funds assets, if the funds with an apostrophe, if the funds assets appear to be larger than expected, if the funds assets appear to be larger than expected. Remember, the contributions are invested, so those are investments, are assets. So if the fund's assets appear to be larger than expected, if the fund's assets appear to be larger than expected, comma, then, sorry, put it this way, I've said if the fund's assets appear to be larger than expected to pay for the benefits. That's what I want to add. If the fund's assets appear to be larger than expected to pay for the benefits, if the fund's assets appear to be larger than expected to pay for the benefits, comma, then the employer may be allowed. The employer may be allowed to take. The employer may be allowed to take a contribution holiday. The employer may be allowed to take a contribution holiday. The employer may be allowed to take a contribution holiday, i.e., stop contributing for a short while. 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 Good. I think I'm through now with that part of the discussion. So finish. I want to develop the topic slightly. So finish. I develop the topic now. Okay. I'm developing now the topic. Now listen. As an employee, in the process of your employment, as an employee, in the process of your employment, there are some benefits that you may be entitled to in the process of your employment. So what we want to discuss are what are those types of benefits that an employee may be entitled to. Types of benefits. In the process of your employment, there are some benefits that you may be entitled to. Okay? Now, let me mention them first. Don't write. One type of benefit that you may be entitled to as an employee is what we call short-term benefits. That's one type of benefit you may be entitled to. We refer to it as short-term benefit. Number two is what we refer to as long-term benefits. That's another type of benefit you may be entitled to. Number three is what we call termination benefit. Termination benefit. Number four is what we call retirement. We also refer to it as post-employment benefits. As post-employment benefits. Now, I am not saying that in your company you may be entitled to all of them. No, it depends with your company. In some companies, 2 of them or 3, whichever the case might be. But these are some of the benefits that you as an employee, you may be entitled to in the process of your employment. So let me go through each of them. Now, number one, we want to discuss a short-term benefit. What kind of benefits are these? These are benefits that accrue to you as an employee. Any benefits that accrue to you as an employee for a period of less than 12 months after providing a service. Any benefits that accrue to you for a period of less than 12 months after providing a service to the employer, that kind of a benefit is what we classify as a short-term benefit. Any benefit that accrue to employees for a period of less than 12 months after providing a service. The most common one is your normal salaries and wages. you as an employee, you are entitled to your salary at the end of every month. So you are entitled to that benefit because you provided a service and it's for less than 12 months. So one example of a short-term benefit is normally salaries and wages. The other one is bonus. There are some companies that tell their employees something like this. At the end of every year, you as an employee, you will be entitled to a particular amount as bonus. So you are paid bonus. If your company pays you bonus at the end of every year, then it's a benefit that accrues to you. It is for a period of less than 12 months after providing a service. So that's another example of a short-term benefit. That's what we are calling bonus. The other one could be leave pay. You are entitled to a leave of 21 days in a year or whichever period of time, and you are still being paid. So that's a benefit that accrue to you for a period of less than 12 months after providing a service. That's how we refer to as, that's what we refer to as a short-term benefit. Any benefits that accrue to you for period exceeding any, just a minute. Okay, I think we can now proceed. So I was saying, just a minute again, something is, just a minute again. Okay. So I was saying, short-term benefits are those benefits that accrue to you for a period of less than 12 months after providing a service. I've given an example like salaries and wages. Bonus, your company, you are entitled to bonus if you are paid bonus at the end of every year, and your leave pay. Every year you are entitled to leave. Good. Now we can go to number 2. What is long-term benefits? Just like the name suggests, obvious, these are benefits that accrue to you for period exceeding 12 months after providing a service. Any benefits that accrue to you as an employee for period exceeding 12 months after providing a service, then that kind of a benefit is what we classify as a long-term benefit. Any benefits that accrue to you as an employee for period exceeding 12 months after providing a service. Now, of course, listen, there are some companies that tell the employees something like this. If you work with us for 10 years, 15 years, 20 years, or 50 years, the moment you clock the 20th year or the 30th year or the 50th year, we shall give you this amount. So they promise you that if you work with them for 20 years or 30 years, the moment you clock whatever you have agreed with that company, that amount that you are entitled to for having provided service for that long, then that is one example of a long-term benefit. And we can now give one example there as Jubilee benefits. As Jubilee benefit. That's an example of a long-term benefit where you work for a certain period of time and your company promises you the moment you clock the 20th year or the 30th year of service, we shall give you this amount as your benefit. That is an example of a long-term benefit. The other one is what we call sabbatical leave, where you as an employee, you go for leave of more than a year and you are still being paid. You go for a leave of more than 1 year and you're still being paid. So that is another example where you may be entitled. Your company says if they go to a leave of more than 1 year, maybe it's a study leave or whatever, we shall still pay you. That's an example of a long-term benefit. Good. So I think I'm through with the second type of benefit that you as an employee, you are entitled to in the process of your employment. I have not said you are entitled to all. I said you may be entitled to 2 out of 3, whatever, depends with your company. So let me now discuss the third one. What is termination benefit? What is termination benefit? Now listen. Even if you have not been taught in class, and you are taught to define this term, termination benefit, it is obvious. You should be able to say something about it, because the term itself is already telling you something. I'm trying to say this because some students, when they go to the exam and they're told to define the following terms, just because the teacher never mentioned, they don't attempt. And yet some of the terms you may be told to define or explain, some of those terms, by the term itself, you can get something or you can explain something. So what is termination benefit? Now, I hope you have managed to think about it now, but termination benefit normally is two-sided. Termination benefit is two-sided. One, let me discuss both sides. It is that benefit that you as an employee, you are entitled to because of the employer's decision. Because of the employer's decision to terminate your services, because of the employer's decision to terminate your services before the normal retirement date or before your contract expires. That benefit that you are entitled to because of your employer's decision to terminate your services before the normal retirement date, then that kind of a benefit is what we call a termination benefit. So maybe your company has such an arrangement that if we terminate you before the retirement date or before the contract, we shall pay you this much. That is a benefit you are entitled to because of the employer's decision to terminate the employee's contract before the normal time, okay? Or terminate the employee's terms before the normal retirement date, okay? Now, the other one is this, the other side of it. There are some companies also that tell their employees something like this, especially those companies which are being restructured. Companies undergoing restructuring, and they tell the employees, we are restructuring our company and therefore we shall need to declare some of the employees redundant. We are giving this kind of a package. Look at it as an employee. If you accept it, we pay you and you retire early. You retire early voluntarily. So the company says, this is the amount you are giving. Look at it. So some people will pick it and go. Maybe they will find and say, it's enough for me to start something, or it's not enough. So some employees will take it and leave. Some might not take it. They continue working. So that kind of a benefit that you are entitled to, listen, that you as an employee you are entitled to because of accepting an early voluntary retirement in exchange of that amount, then that kind of a benefit is also classified as termination benefit. So we are saying termination benefit is that benefit you as an employee you are entitled to because of the employer's decision to terminate your services before the normal retirement date, or it is that benefit you are entitled to because of the employee's decision, decision to accept an early voluntary retirement in exchange of the benefit, That's how we define a termination benefit. It is either because of the employer's decision to terminate your services before the normal retirement date, that amount is what we classify as termination, or the benefit that you are entitled to because of you as an employee accepting an early voluntary retirement in exchange of a benefit. Of course, most of you have heard what we normally call golden handshake. There are some companies that give what we call golden handshake. That's an example of a termination benefit. We now go to the last one, and that is what we are calling retirement, or what you can call post-employment benefit. What kind of a benefit is this? It is obvious. It is that benefit that you as an employee you are entitled to at the date of retirement or after the date of retirement. Any benefit that you are entitled to at the date of retirement or after the date of retirement, that kind of a benefit is what we classify as a retirement, or what we can call post-employment benefit. It is obvious. The most common one is what we call pension. That's an example of a retirement benefit. You are entitled to your pension at the end of your retirement. That's one example. Now, another one. There are some companies that tell their employees something like this, that even after you have retired, we as a company, we are still going to provide for you your medical care. We are still going to provide for you medical care. So if your company has that kind of arrangement, where that even after your retirement, they still provide you medical care, then that is another example of a retirement stroke, what we are calling a post-employment benefit. So the other example is what we are calling post-employment medical care. Post-employment medical care. If your company has it, not all companies have. There are some which do have that. Even after the retirement, they still provide you medical care. So that's another example of a retirement, or what we can call post-employment benefit. Good. So you may be told to define some of these terms. So one should be able to define them. So let's put them down. Let's put them down. So have another subheading: types of benefits. Types of benefits. Types of benefits. Types of benefits. Number one. Types of benefits. Number one, short-term benefits. Short-term benefits. Then you say this. These are benefits. These are benefits that fall due. These are benefits that fall due within 12 months. These are benefits that fall due within 12 months after providing a service. After providing a service to the employer. These are benefits that fall due within 12 months after providing a service to the employer. These are benefits that fall due within 12 months after providing a service to the employer. AG, salaries and wages. AG, salaries and wages, comma, bonus, comma, leave pay, etc. We have said AG, salaries and wages, comma, bonus, leave pay, etc. That's all we can say about short term. Number two, long-term benefits. Long-term benefits. These are benefits accruing. These are benefits accruing for periods exceeding. These are benefits accruing for periods exceeding 12 months. These are benefits accruing for periods exceeding 12 months after providing a service. These are benefits accruing for period exceeding 12 months after providing a service. After providing a service. AG, Jubilee benefits. AG, Jubilee benefits. And sabbatical leave. AG, Jubilee benefits and sabbatical leave. e.g. jubilee benefits and sabbatical leave. And sabbatical leave. Number 3. Number 3. Termination benefits. Termination benefits. Termination benefits. These are benefits payable. These are benefits payable. Either. These are benefits payable either as a result of. These are benefits payable either as a result of the employer, sorry. These are benefits payable as a result of either the employers with an apostrophe, either as a result of the employer's decision, either as a result of the employer's decision to terminate the employee's contract, to terminate the employee's contract before the normal retirement date. To terminate the employee's contract before the normal retirement date. I've said these are benefits payable either as a result of the employer's decision to terminate the employee's contract before the normal retirement date, or continue, or on the employees, now with the employees, or on the employees with an apostrophe, or on the employee's decision, or on the employee's decision to accept, or on the employee's decision to accept an early voluntary, or on the employee's decision to accept an early voluntary retirement in exchange of the benefit, or on the employee's decision to accept an early voluntary retirement in exchange of the benefit. Good. That's all we can say as number 3, termination. We can now go to the number 4. Retirement stroke post-employment benefit. Retirement stroke post-employment benefit. Retirement stroke post-employment benefits. Then you say this. These are benefits that accrue to employees. These are benefits that accrue to employees at the date of retirement. These are benefits that accrue to employees at the date of retirement or after the date of retirement. These are benefits that accrue to employees at the date of retirement or after the date of retirement. We are saying retirement benefits or stroke post-employment. We also call it post-employment. These are benefits that accrue to employees after the normal retirement date. So at the date of retirement, or after the normal retirement date. These are benefits that accrue to employees These are benefits that accrue to employees as at the date of retirement or after the date of retirement. E.g. pension, e.g. pension and e.g. pension and post-employment medical care. E.g. pension and post-employment medical care. and post-employment medical care. And post-employment medical care. Good. Okay. So we are through with that. I want to develop the topic before we do a few computations now. So before we do a few calculations, we need to define what we call other terms. Don't write other terms used in pension. Other terms used in pension. There are some terms you may be told to define which are normally used in this topic, and we shall also use them, some of them, in our calculations. So let me define some of the other terms that the examiner may tell you to define them. So one of the terms you may be told to define is what we call funding. Number two is what we call funded scheme. That's another term you may be told to define. Number three is what we call unfunded scheme. What is unfunded scheme? Number four, you may be told to define what is, you may be told to define what is a current, we also call it present, service cost. Number five, you may be told to define what we call past stroke prior service cost. Another term you may be told to define is what we call actuarial gain stroke loss. Actuarial gain or loss. You also may be told to define what we call experience surplus stroke deficit. Another term you may be told to define is what we call experience adjustments. So these are various terms that you may be told to define. So let me go through each one of them and how we define it. What is funding? For me to explain the term funding, I need to take you back on how we say it. How does a pension scheme operate? I told you this, that in a pension scheme, contributions are made. Don't write this, to a fund. I said those contributions are invested by the funding agent, who later pays the benefits to the employees when they retire. Now listen. So every month or every year, whatever the case might be, you as an employer, you will be sending contributions to the fund. Those contributions are normally invested so that the funding agent will be able to pay the benefits at the time of retirement. So it is obvious, every time I send contributions into this fund, what am I doing? I am funding that fund. So what is funding? That's what we are saying. It is the process of making contributions into a fund. It is that process of making contributions into a fund so that those contributions may be invested by the funding agent, who later pays the benefits to the employees when they retire. That's all we can say about funding. What is funding? It is that process of making contributions into the fund so that those contributions may be invested by who? By the funding agent, who later will pay the benefits to the employees when they retire. So that's all we can say concerning funding. That process of you making contributions to the fund. What are you doing as a company? You are funding that fund. Okay. So maybe we can put it down. Let us just put down one by one. So have another subheading. Other terms used in pension. 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 Number one, funding. So you are putting down the subtopic, other terms used in pension. Number one, funding. Then you say this. This is the process. This is the process of making contributions. This is the process of making contributions into a fund. This is the process of making contributions into a fund so that the funding agent may invest the contributions and later pay the benefits to the employees when they retire. So we are saying it's the process of making contributions into a fund so that the funding agent would invest the contributions and later pay the benefits to the employees when they retire. Good. That's all. Finish. I want to go to the second one. I want to go to the second term. What is a funded scheme? I want to use my illustration to discuss what is a funded scheme. Okay, let me explain it. Now listen. As a company, let's call you A, you normally make your contributions to a trustee or a funding agent. Let's call it a trustee, which is another company B. This funding agent B will invest those contributions and later pay the benefits to the employees when they retire. Listen. So you as company A, you are making your contributions to a separate entity. I've said, sound broken. Now listen. I said, what is funding? Let me first explain before we put down the term. I said this. Every time you as an employer, you make contributions to the fund, those contributions are normally invested. That's what I said. Once they're invested, I said the funding agent will pay the benefits at the time of retirement. Now, that process of you as an employer making contributions to the fund, that process is what we call funding. You as an employer, you are funding this fund so that the funding agent would invest those contributions and later pay the benefits to the employees when they retire. Are you there now? What is funding? I've said it's the process of you as an employer making contributions into the fund so that the funding agent may invest those contributions and later pay the benefits to the employees when they retire. Then we write the notes and I said it is the process of making contributions into the fund so that the funding agent would invest those contributions and later pay the benefits to the employees when they retire. Are you okay, Daniel? What's funding? It's the process of making contributions to the fund so that those contributions are invested by the funding agent who later pays the benefits to the employees when they retire. Thank you. We have said yes. So now I was discussing the second term and I was saying, you as a company, we are discussing the term funded scheme. Listen to this now. You as a company, you make your contributions to a funding agent. You are a company A. You made your contributions to a funding agent B. This funding agent B invested the contributions and later pays the benefits to the employees when they retire. Now, when you as an employer A makes contributions to an external entity B, Remember, the moment you make those contributions to company B or entity B, you have no authority on how to tell them to invest those contributions. When you send your money to NSSF as an employer on behalf of your employees, you don't tell the NSSF how to invest that amount. No, they have the authority to decide. So when you send your contributions to an external entity, which is separate from the employer's company, then we refer to that kind of arrangement as a funded scheme. So a funded scheme is an arrangement whereby contributions are made to an external entity. It is that external entity which is the funding agent who will invest the contributions and later pay the benefits to the employees when they retire. Okay? Before we put it down, let me now compare that with what I called unfunded scheme. Number 3 was unfunded scheme. They are related, so that I want you to see the difference. Now, in other companies, what they do is this. This company A may decide, instead of sending the contributions to another entity B, which is separate from them, they decide they are still going to contribute the contributions, but those contributions are retained in the business. It is the business, yes, they are making contributions. What they will only do is to pass the double entry. That this year I'm supposed to make a contribution of 2 million or 2,000 to the employees. That automatically means as an employer, I have a liability to pay in the future. So I just debit an expense account and I credit a liability account somewhere. It's an amount I owe to my employees. Listen, so I don't send those contributions to an external entity. Instead, those contributions are retained in the business. They are retained in the business. Then, at the date of retirement, it is the employer now who will pay the benefits to the employees when they retire. It is the employer now who will pay the benefits to the employees when they retire. So in this case, the contributions are not made to an external entity. No. But the contributions are retained by the business. In other words, the employer normally does what we call, they reinvest the contribution. They reinvest the contributions into the business. Instead of sending them outside, they know they owe you 2 million or 1 million or whatever. They keep increasing your liability as an employer. Then at the time of retirement, they are the ones to pay you the amount of the benefits. Okay? But we are saying those contributions are retained in the business. In other words, the employer normally reinvests those contributions. It's not a common approach among companies, no, but it is possible. It used to be there, but normally the accounting standard prefers the first approach where you make your contributions to an external entity. So most companies use this approach we are calling a funded scheme, where the contributions are made to an external entity which is separate from the employer. That separate entity will invest. They pay the benefits to the employees when they retire. Alternatively, in an unfunded scheme, obvious, I've said the contributions are not sent to an external entity. Instead, they are retained in the business and they are reinvested back into the business. Then it is the employer who pays the benefits to the employees when they retire. It is the employer who pays the benefits to the employees when they retire. Now, of course, each of these two arrangements has its own advantage. Like, for example, if I am an employee, I would prefer to go into a company that has a funded scheme. Why? Because I know that my contributions are made to an external entity. So in case something happens to company A, and they are liquidated, then my contributions are saved somewhere with company B, which is this entity or the agent. But if your company chooses unfunded scheme and the employer is the one who is retaining your contribution, in case of anything going wrong, then you as an employer, you lose your contribution in case they are liquidated or declared bankrupt. But the advantage for that method number 2 is because the advantage is to the employer, because he has the ability to reinvest those contributions. So this second approach, which we are calling unfunded scheme, is only beneficial to the employer because he has the ability to reinvest the money back into the business. But to you as an employee, in case anything happens to company A and they are liquidated, you stand to lose your contributions or your benefits. But for an approach we are calling a funded scheme, once your contributions are sent to an external entity, in case anything happens to your employer, that means they are liquidated, your contributions are saved somewhere with another entity. Okay, good. So I think we can put down those two because they are related. So let's put down those two. We have already written down number 1, funding. Let's now put down number 2 and number 3. So have another subheading. Number 2, have a number 2, funding, or funded scheme, sorry. Funded scheme. Funded scheme. Funded scheme. Then you say this. Under this scheme, put it that way, under this scheme, contributions are made to an external entity. Contributions are made to an external entity. Contributions are made to an external entity which is separate from the employees, with an apostrophe, which is separate from the employees' company. Which is separate from the employees' company. We'll stop. Continue. The funding agent would invest the contributions. The funding agent would invest the contributions. The funding agent would invest the contributions and later pay. The funding agent would invest the contributions and later pay the benefits. And later pay the benefits to the employees when they retire. And later pay the benefits to the employees when they retire. And later pay the benefits to the employees when they retire. Good. That's all about number 2, funded scheme. Number 3, so we have said number 2 is where contributions are made to an external entity. Number 3, unfunded scheme. Let's put it down. Already we have discussed it. Unfunded scheme. Unfunded scheme. Then you say this. Under this scheme, contributions are not made. Under this scheme, contributions are not made to an external entity. Under this scheme, contributions are not made to an external entity. Contributions are not made to an external entity, comma, but they are retained. But they are retained into the business. They are retained into the business. We'll stop. But they are retained into the business. Continue. The contributions are reinvested. The contributions are reinvested back into the business. the contributions are reinvested back into the business. The contributions are reinvested back into the business. Will you stop? The contributions are reinvested back into the business. Will you stop? Then you go on and say, at the date of retirement, at the date of retirement, at the date of retirement, comma, it is the employer who pays the benefits to the employees. At the date of retirement, it is the employer who pays the benefits to the employees. At the date of retirement, it is the employer who pays the benefits to the employees. Good. Good. Okay. You will allow me to stop there for today. Next time I'll discuss the other remaining terms. Then we now go into the computation part of the topic. But what we have said already is partly examinable. Don't forget that. I've told you in financial reporting, it is normally tested, those theory part. So what we shall do next time, we shall finish the other remaining terms. Then from there, we now do a computation question. Then, now, before we close the class, I've already said we can stop there. We finish next time. Then, of course, then we shall do the computation part. But before we leave, some of you, listen, some of you have friends who have not joined our online classes. So you can tell them through your friends, or some of you are here and you have not joined our online classes. Please tell your friends that we have online classes for the following subjects. 1, advanced financial reporting of the advanced level. Tell your friends we have that one subject. Number 2, we have online classes for financial reporting, the one we are doing now, of the intermediate level. Tell them we also have online classes for financial management of the intermediate level. We also have online classes for financial accounting of the foundation level, and the one of ATD1 and ATD2. They also have financial accounting there. So those are the 4 subjects we are offering online classes as at now. Tell your friends that if they cannot be able to join the online classes, the live classes, they can still buy what we call the pre-recorded videos. They can still buy the pre-recorded videos and watch them at their own free time, at their own pace. That's another thing they should know, that they can watch their videos at their own free time, at their own pace. Whenever they have a question, call me anytime. Call me anytime. Good. Now, for them to reach me, they can call me on this number, 0722-658875. That's my number. They can get me on that number. That is what you can give them, 0722-658875. Let them call me for more information about the cost, whether we accept payments on installments. Of course, we accept installments. No problem. Good. Alternatively, for those who need the country code, it will be 254-722-658875 for those who need the country code. Now, some of you are watching me through YouTube. Some of you are watching me through YouTube, and maybe you have not subscribed to my YouTube channel. Please click that subscription button to subscribe to my YouTube channel, so that you may be notified whenever we post new videos into the YouTube. Sometimes we post new videos into the YouTube for promotion purposes, so you can be notified whenever we post new videos into the YouTube. So go to the button down there, click that subscription button, so that every time we post new videos into the YouTube, you may be notified. Of course, the name of the YouTube channel is called CPA Joseph Njuguna. That's the name of the YouTube channel, CPA Joseph Njuguna. So if you are here and you have not watched my videos there are some which are there for promotion only, not for the whole syllabus, but for promotion. you can watch some of them which are on my YouTube channel. That is the name of the channel, CPA Joseph Njuguna. Now, again, for those who are watching me through YouTube, and of course hope you have understood something today, click that like button. Click that like button down there on the YouTube to like the class. I do hope you have managed to understand something for today. So you can click that like button, and even you can comment if you want to comment. I think that's all I wanted to mention before we close the class for today. Tell your friends that we have these online classes for those 4 subjects. That is for advanced financial reporting of the foundation, advanced financial reporting of the advanced level, financial reporting of the intermediate, financial management of the intermediate, and financial accounting of the foundation level, and the one of ATD. Then I've said, if they are not able to join the live class, for whatever reason, they may be missing 1 or 2 classes, they can still buy, or they can still get what we call the pre-recorded videos, so that they can watch the videos at their own free time, at their own pace. They can reach me on this number, 0722 658875. Then I've said, for those who are watching me through YouTube and you have not subscribed, please click that subscription button down there and subscribe so that you may be notified. Because we have said the name of the YouTube channel is called CPA Joseph Njuguna. Then I've said, click that like button to like the class. So maybe for today we can stop there. We pick it up from there next time. Maybe for those who are watching me through Zoom, unless you have a comment, I hope you have understood something for today. Those who are watching me through Zoom, you can say yes if you have understood something for today. I want to believe you have understood something today. You can put down 1 or 2 comments before we close the class. I hope you have understood something. For those who are watching me through Zoom, you can put down a comment. Yes. Somebody says yes. Thank you. You have understood. That's what you have said. Okay. So unless there's another comment, I want to close the class now. Thank you. Yes. Somebody else, Christine, Bridget, well presented or well presentation. When are we meeting? Of course, you will be notified. Sawa. So call me if you're interested in our class. Call me on that number. We may discuss more. Good. See you next time. Bye for now.